Good morning, everybody. It's great to be here again, and feel like we're on this quarterly rhythm now with Blake McKibben, our wealth and estate strategist, technical title for in-house state attorney, and then I am Nate Angelo, head of wealth management here at Composition Wealth, and we are looking forward to the next 30 minutes or so talking a little bit about updates as it pertains to Washington State and specifically Bill 5813. And I love Blake's title here, Taxing Times Ahead. And so no pun intended, but at the end of the day, there are tax conversations to be had. And so we're going to do that. We want to make this a dialogue. And so Blake has a number of prepared remarks, which we'll get into in a couple of minutes. But let me remind you that if you have questions, there is a Q&A box at the bottom of your screen. Feel free to click in there, put your question there. I will see it and I will gladly weave your question into either our conversation as he's going along, or if it makes sense at the end, we'll circle back to all questions that come in. And so we're excited to talk about some of these important updates. And just as a reminder, here at Composition Wealth, we believe that it is important that we surround clients and their significant others with thorough financial planning. And so when we think about financial planning, there's a lot that goes into it. And certainly it starts with understanding who you are, understanding what it is that you want to accomplish both in the short and longer term. And then inside of that, there's a lot of work that comes down the pike as life evolves and candidly life happens. And so when it comes to understanding income tax strategies and managing for capital gains, understanding where assets should reside, understanding the protection of those assets, and how do you pass on assets, and how do you ensure that your legacy carries on the way in which you desire, managing risks, helping you forecast income needs and cash flow needs and distribution needs. And so all of those are things that we are passionate about supporting our clients with. And today we're going to really spend time, as we talked about specifically this new Washington bill that's been passed. And that really falls into this category of wealth strategy and protection of assets and the impacts on spending and the impacts on our tax planning specifically. And so in our agenda today, we have 4 different things that we're going to cover. We're going to talk a little bit about state and federal capital gains. And so this will be a little bit of what's the state of the union as it pertains to capital gains. Then we'll talk about what kind of planning may we consider based on your specific situation. We'll talk a little bit about state and federal estate tax updates. And then estate tax planning options at the end. This is the world that Blake lives and breathes, and he's done it for a couple of decades, and he's fantastic at it. And so I know he's got a lot of knowledge to share. And then I'll just say this up front. Blake will probably say it a couple of times, and I'll say it again at the end. There are, I'm sure, a lot of questions that stem beyond the Washington State tax situation based on what has been passed, or what was passed on July 3rd, and that being the One Big Beautiful Bill. And so we have an upcoming webinar just 2 weeks from now where we will actually dive into sort of the national impacts of that bill and what does that mean, and we'll unpack all of that for you. That's actually going to be a larger panel, so certainly I will be back, Blake will be back, but we're going to have our head of financial planning, our chief investment officer as well. And so we look forward to a very candid conversation and dialogue around the bill itself and what are the impacts as a result of that. But this morning, we're excited to focus on Washington State and some of the impacts of 5813. And so with that, Blake, our internal estate attorney, I'll turn it over to you and look forward to hearing what you have to share this morning.
Great. Thank you so much, Nate. And thanks everyone for spending some time with us here today. We're going to start with an overview of the capital gains tax and what has changed. But first, as Nate said, do a little state of the union of where we are, how we got here. Right. So, historically, Washington had no state income tax, which included no tax on capital gains. That changed in 2022 when Washington passed the law creating a 7% excise tax on long-term capital gains. I said excise tax because as soon as that was passed, legal challenges immediately followed, with opponents saying that this was a unconstitutional income tax in disguise. However, in 2023, Washington Supreme Court upheld it as an excise tax and not an income tax. So yes, it was challenged. However, it stayed and is the law that we are building upon here today. Now, ever since the beginning, there was exemptions to the tax. So these are, first of all, the first $250,000 of gain per individual, which that is indexed for inflation annually. They haven't released the 2025 figure yet, but 2024 is up to $270,000 you can exclude from any of these gains. And then the other that's important to note is the sale of real estate. Real estate does not trigger any of these capital gains taxes. So a little overview, here's what it applies to. First, it's of individuals. That's important too. Individuals in Washington state with long-term capital gains that are allocated here to Washington. Now it applies to tangible property like planes, cars, boats, artwork, things like that are located in Washington at the time of sale. Again, located in Washington. That's important to know. It also applies to intangible property like stocks. That's really what most of our, we're going to come across is stocks and intellectual property, things like that. But again, owned by individual taxpayer domiciled in Washington at the time the sale occurred. So what happened? Well, the new updates were signed into law on the 20th of May of this year. It added to the tax. So one thing to note, it was retroactive. So it applied to all gains that happened starting January 1st of this year. That's pretty big. So there's nothing you can do to get the old laws. It already is going to apply for anything happening this year. The other thing that it does, well, the most important thing that this update did is creates an additional tier, which when gains are over $1 million, then there's an additional 2.9% that is going to be tacked on to that 7%. So here's how it looks. So again, effective January 1st of this year. So the tax rate on the gain of sale from 0 to 270, actually, it's probably going to be a little bit more based on the inflation adjustment. So let's say 280, right? 0%, right? So the vast majority of families won't be touched by this. Okay, but if you have the gain that's more than 270 and up to 1,270,000. So that's how the tier works. It's 0 to 270, and then it's the next a million is still that 7%. But it's anything above and beyond that will get that extra 2.9%. So above 2.7 will get 1.27 will get 9.9%. So here's just an and before we talk about an example of that, let me just give you a real brief understanding of the federal capital gains tax rate. So, as Nate said, we're getting ready in a few weeks' time. We're going to talk about the One Big Beautiful Bill Act and all the changes. Well, this is one thing that it did not change. So income taxes are going to remain the same for 2026. That was always a fear. Of course, these numbers for 2026 will get adjusted for inflation, but still the same fundamentals will occur in 2026 and ongoing because the One Big Beautiful Bill Act for things like income tax has been made permanent. We'll talk about that in a few weeks. But so here's the rates, right? For single and married filing jointly, right? The tax rate is 0 on these gains, 0 to 48, or married filing jointly, just under 100,000. 15% tax rate. You can see the realm in there, and then the 20% rate. Singles over 533, married filing jointly over 600,000. However, there is an extra 3.8% tax. Now it's called the net investment income tax that adds an extra 3.8%. So if you're in the highest tax bracket, typically you're going to be not charged at 20%, at 23.8% at the federal level. So here's just an example. So let's say we have Susan, $3 million of Apple stock, bought it for $1.2 million, wants to sell it today. Well, actually, let's say she sold it last year. She sold it in December of last year for $3 million, capital gain of $1.8 million. Okay, so the result for 2024, Washington capital gains tax just over $100,000. Federal capital gains with that net investment income tax, the 23.8, that gets you at a total tax of $535,000 on that $3 million sale. So here's the difference with the new tax law. So again, remember that is only that additional amount on the above the $1 million of gain. So you'll see here the Washington capital gains tax, it goes up by about $15,000, right? The federal stays the same, and I'll talk about the difference of that with the estate tax here in a little while. So the difference here is going to be about $15,000 of difference selling that last year versus this year. Now, of course, you add another zero to the sale, and this really starts to add up and become important consideration to think about. So, what are some planning options? How can we avoid imposition of the Washington state tax, and especially this new tier? There's a lot of different things to do, ranging from easy, I guess, to more nuclear option. The first is, if you're able to, maybe try to draw out that sale over multiple years through an installment sale. So, for example, if you have $1 million that you're going to sell to somebody, some sort of asset or property or something like that, well, if you stretch that out over 5 years and charge 7% interest, well, you're going to avoid Washington capital gains tax completely, because every year you're going to be under that $270,000 threshold. So if that's an option, that's something to consider. Oftentimes it's not, and sometimes this is kind of a hassle, because in this scenario, you are serving as the bank. So if the person that you're selling to defaults, well, you've got to fight and on down the line. So if it's an option, consider it. Installment sales can make a big difference. Another thing you can do, again, if this is an option, you can make gifts to others before the sale. In that way, you're going to spread out the gain over your other family members and people that you've gifted to, and hopefully you stay below thresholds. And maybe they're in a different tax bracket from you anyway, so the federal income tax, they might not be in the 23.8, maybe they're in the 15 or something like that. So that's another option, giving to others to spread out the gain. Now, that comes with a whole host of other issues, and we can talk about some of these planning issues, because of course, if you gift assets to people, it's subject to their creditor. So maybe you want to make a little more sophisticated gift into a trust or something like that. Happy to talk about ways you can structure these types of gifts. Another one is, this is a part of the law as well. This can help reduce your tax burden if you make a charitable gift to a Washington-based charity. It has to be Washington-based. It can't be outside of the state. It has to be in Washington. You can deduct up to $108,000 for charitable gifts made to Washington charities. So this is a great way to keep some of the money here in your favorite charities and not going to Olympia. So that's something to consider along the way. Here's another option. Remember I said that this law only applies to individuals. It does not apply to a irrevocable non-grantor trust or a charitable remainder trust. We'll talk about these just real quick. So an irrevocable non-grantor trust, that is a trust that you have created Typically, these are a Nevada trust or a South Dakota trust or a Delaware trust. These are things that you can set up for asset protection purposes and to avail yourself of the other states' laws. Now, it has to be a non-grantor trust, meaning that the trust itself is its own tax entity. And that is what gets the reprieve from the Washington state tax, because the trust is not an individual. It's a trust. It's its own tax entity. So irrevocable non-grantor trust will work to avoid. Now, some of you might be thinking, well, I got scared into creating a spousal lifetime access trust because my attorney was saying that the estate tax was going to change and we had to do some gifting and this, that, and the other. Well, there's devil in the details. That might help for some other planning purposes, but typically spousal lifetime access trusts are structured as grantor trusts. Those are types of trusts that do not have their own separate tax identity. So you might have other structures that exist out there, but it's worth examining to see if they might hold water and help avoid some of the Washington state income taxes. Now, one way that you can do it is by this called a charitable remainder trust. Excellent tool to help you, and this is great for highly appreciated assets. It's a device that you create while you're alive, and you retain an income stream for a certain number of years or over your lifetime or over joint lifetime, husband and wife. And then at death, whatever's left goes to a charity. This is another type of a vehicle that is not an individual, so it avoids the Washington state capital gains, but it also will help to spread out the gain over a long period of time, your lifetime. And there's a lot of complicated rules, but it is a tried and true method that has been around since the 60s. And tried and true in the fact that the IRS actually provides sample legal documents, and it's right there in the Internal Revenue Code. The Internal Revenue Code is it's hundreds of thousands of pages long, and inside of there are specimen charitable remainder trust documents. So if this is something, happy to speak more about this. A great tool for highly appreciated assets that you get to retain a lifetime income from, and then at death, your favorite charity or your donor advised fund gets what's left. And the other nice thing, you get an income tax deduction while you're alive today for making that, creating that structure. So that's another tool, again, out beyond the scope of what we want to talk about here today, but reach out to us and we're happy to talk about it. Now here's another one. This is the nuclear option. This is the Bezos option, right? I saw that he just sold a bunch more Amazon stock the other day. But yes, move to a different state. That's it. If you move outside of the state of Washington, well, and your tax residency is Florida or Nevada or wherever you want to move, Washington state will not be able to tax you. So that's probably too far and too much. You got so many ties and family and the like, but it's happening, and people looking for more sunshine, I guess, as well. So that's what we look at, the Washington state capital gains. It's new. It's been added to, so top rate now 9.9. Otherwise, it's 7%, but that first 270,000 is exempted from any Washington state tax. Now, let's shift gears a little bit. Talk about estate taxes. So Washington state has had a estate tax. The exemption was ever since 2018. It had been stagnant. It was 2.193. Now the exemption, that's the amount that each of us can pass on tax-free at death. The new estate tax update increased that exemption from that amount up to $3 million per person. However, devil's in the details. Again, at nearly every tier, there was an increase in tax rates. And I'll show you that here in the next slide. Now, the one thing to keep in mind, still, Washington state has no estate tax portability for state estate taxes, whereas the federal government provides estate tax portability. What does that mean? Well, at the federal level, if I pass away and leave everything to my wife can then file a tax return at my death saying my husband didn't use his exemption. I want to preserve this and use it at my death. It's portable from one spouse to the next. And of course, in a few weeks, we'll talk about the estate tax with the One Big Beautiful Bill Act and how that changes. But so again, federal level, if I don't use it, my wife can use it. That's not the case in Washington state. Washington state has these use it or lose it type of a rule. That means if I pass everything to my wife at death, my exemption is lost. Or if I have my assets owned improperly or beneficiary designation, like everything goes to my wife, well, or if I don't use my full amount, it's lost. So important to think about as you think about owning property and ownership of assets between the two spouses and the like. Now, the difference, so the capital gains tax, that applied back to January 1. This applies to deaths occurring on or after July 1st. Okay, so the other one was retroactive. This one is now active, has been active for a few weeks, but deaths occurring after that date. Again, there's a carve out here. This only applies to assets owned in Washington state. So that vacation property in Florida or, things you own in other places are not a part of your Washington taxable estate. So you think about that, I've got interests in winery in California or whatever. That's not part of the Washington estate tax, only Washington-based assets. Now, also important to think about, Washington continues to have no state gift tax. And so, and we'll talk about this, you can gift to others. And oftentimes this happens at the first spouse's death, where the step up in basis happens and you gift assets. Washington state, no state gift tax, doesn't impact the exemption. Whereas on the federal level, yes, there is a federal estate and gift tax exemption and amount. Again, beyond the scope of what we're going to talk about here today. If you'd like to learn more, reach out to us. We're happy to talk about that with you. So here is what the tax law as it stood prior to the 1st of July. So the tax rates, it was a tiered rate system, bottom rate 10, top rate 20%. Now this is the net taxable estate, remember? So this isn't everybody who has $0 to $1 million is taxed at 10%. No, this was just the first $1 million above and beyond that $2.193 million. Okay, so that's important to note here. So how did it change? Well, as I said, just about every single tier along the way, the tax rate went up. And so we went from having the top tax rate in last year or a month ago was 20%. Now it goes all the way up to 35%. Pretty substantial change in the estate tax world. Now the federal, again, we'll talk about this, the One Big Beautiful Bill Act, but this has been pretty much set from 2017, index for inflation, but today in 2025, 13.99 million per person exemption. It is portable. If I don't use it, my spouse can, right? 2026 and beyond, One Big Beautiful Bill Act says we're doing a $15 million exemption per person. Portability remains the same. All these other things remain the same. And they're going to scale that for inflation as time goes on. One thing to note, this is a permanent tax law. The one passed in 2017 was temporary. The one passed in, we've had, temporary law after temporary law after temporary law. Here we've got a permanent law at the federal level. So Here's an example, okay, of Susan, single person who dies with an estate of 18,250,000. Okay, so if she were to have passed away at the end of June in 2025, here's what it would have looked like. The Washington state estate tax would have been just under $3 million. Now, the federal estate tax would have been pretty significant as well, leaving a total of just about $3.45 million of estate tax. Here's the difference. If she died one day later, her estate tax bill is going to go up about $700,000. Pretty substantial amount. Now, here's what to note here, and this is what's different, is that any taxes that are owed to Washington state will lessen the amount of tax that is paid to the federal government in federal estate tax. That's not the case in capital gains tax. I remember that slide, capital gains tax, it didn't matter what happened in Washington, the federal rate was the same every single time, but not for estate tax. It works a little different. So the state estate tax goes up significant, a little over $1 million more, 1.2 million and change more. But the federal estate tax goes down a little bit for the net result of a $700,000 difference. Right? So the difference between 1 day difference in death made a huge impact to Susan. Okay. So how can we plan for the changes in the Washington state estate tax? Again, look at the most basic and fundamental is making sure that each spouse takes full advantage of their estate tax exemption. As we said, Washington state not portable, right? So I have to fully utilize my exemption at my death or it's lost. And so that goes back to just reviewing your estate plans and reviewing the ownership of assets just to make sure that at death, we're going to fully maximize as much as we can into some sort of a structure. We might call it a family trust or a bypass trust or a credit shelter trust that's created and funded at the first spouse's death to fully maximize that. So that's fundamentals of estate plan. Now, another more sophisticated, again, could be really simple, could be more complicated, make gifts to others, either outright or in trust. Probably, if it's going to be a large amount, we'll talk about trusts and how you might structure that. Again, remember, there is no Washington state gift tax. So you're free to make gifts to family members or others to reduce your own Washington state estate tax liability. Another way is the nuclear option, the Bezos option. Again, move to a different state. Right? Some of us, that's not an option. So what you might do is maybe start ridding yourself of some Washington-based assets. Remember, as we said, the Washington state estate tax only applies to Washington assets. So a vacation home in California or something like that versus that second home in Washington, maybe that makes more sense. You move to California and then California doesn't have a state estate tax. You're just worried about the federal and that's something to plan for as well. So moving to a different state, shedding some of the Washington state assets will help you to eliminate or avoid as much Washington state estate tax as possible. Now there's a myriad of strategies that we can help you look at and discover if it makes sense for you and your families. So this is really just our grab bag, our toolbox that we can dip into to help you to do some income tax planning, estate tax planning, and help do some charitable planning and benefit the ones that you love. So a lot to talk about. So we talked real briefly about the changes here in Washington. We highlighted this along the way, but the big, beautiful bill, which is maybe a little bit more impactful, maybe not. But tune into that because there's a lot of things that we're just digesting, and I was just on a webinar here this morning on it was top estate planning attorneys around the country talking about the changes and what it means for estate planning, and it is pretty substantial. We're going to see a lot of changes beyond what you'd expect. There's a lot of details in this law, so please tune in here in just a few weeks' time on July 30th at 10 o'clock.
Blake,
so thanks for spending time, and Nate, I'll send that back over to you.
Fantastic job. Thank you for the details and the application. Just one question that I would throw to you. So if I'm a client and I'm listening and I'm thinking through this, and now all of a sudden, this has spurred me to think through my tax situation, whether it's estate tax, whether it's income tax, whether it's capital gains tax, as I'm thinking about making decisions that maybe I haven't shared with an advisor, or haven't consulted with an advisor, and or a CPA for that matter. Maybe you could just talk about how many of our clients work in conjunction with us as an advisor, you on an estate tax perspective tied to a CPA. Like, our role here, I don't think is to usurp anybody. I think our role here is to be a quarterback and help people navigate. But maybe you could just talk about how you help partner with clients, advisors, CPAs, etc.
Oh, absolutely. Happy to do that. And yeah, the way I like to explain it is we're here to supplement, not supplant your local advisors. Now, one thing, and when I was practicing law, I was guilty of this as well, right? That people would only come in to see their attorney when something bad happened, or when somebody was born, or marriages, or divorce, or things like that. It wasn't that often that anyone would want to come in and see their attorney. And the same thing with your CPA. Maybe you have a great CPA that does more quarterly planning updates for you, and you can kind of work through that, and that's wonderful. But typically, what we see is CPAs, again, they're there in the background, and when tax season comes around, they get into the picture. So, what we realize that we have a much greater and closer connection to you, our clients, because we have a lot more interaction with you. And so our role, again, it's to supplement working with your local advisors, because we know a lot of the picture. We know the finances, and we know a lot of family history and the like that we're happy to help portray and convey to local advisors. And so, yeah, we welcome it. We want to be a part of the process and help facilitate these discussions, help brainstorm, and then help put these things, put these plans into action for you with the help of your local advisors. And so, yeah, we're here as an educational piece, as a sounding board, but also coordinators. And working, with, not against your local council.
Wonderful. Well, Blake, thanks again for sharing your insights and the details and the updates. Hopefully everybody can join us on July 30th when we really dive into the details and unpack the one big, beautiful bill, along with our esteemed colleagues in financial planning, as well as from investments. And so thanks again, everybody, for your time. Thank you for your trust and the opportunity that to serve and to work alongside you in this journey called life. Blake, thanks again. Everybody be well.